Good afternoon and welcome to our webinar series, Understanding and Optimizing Social Security Benefits. I'd like to quickly update you on some upcoming chapter events. We've got another webinar series, Divorce and Dollars, Financial Planning for Divorce Scenarios on April 16th, an end of tax season happy hour and networking social on April 18th, and last but not least, our annual symposium on May 2nd. Please check out our website for details and register today. We are joined by Thomas Drapala, RSSA, Director of Strategic Partnerships and Registered Social Security Analysts. RSSA is the leader in Social Security training and education for financial and insurance professionals. Please submit your questions via the Q&A feature within the Zoom controls at the bottom of your screen. Thomas will answer all of those at the end of the presentation. And with that, I'll turn it over to Thomas to begin.
Thanks, Kathy. Yeah, and I appreciate everyone coming on today and learning a little more about, Social Security, especially as it relates to helping our clients with this important retirement decision. Now, some of you on the call, or maybe a lot of you on the call today might already know a lot about Social Security, or at least enough to be dangerous, right? But hopefully this gives you a little more understanding about, some of the things that your clients might ask you, some of the things that might have been confusing in the past, and kind of just give you that overall understanding of some of the basics and some of the things that your clients might have questions on. And then we'll also talk a little bit at the end about the RSSA Social Security Program if you're interested in adding this level of education and training to your practice, and opening doors for insurance, annuity, assets under management, and other opportunities. We'll tell you kind of where to go to learn more about that as well. But again, I want to go through, some of the interesting things about Social Security, some of the basics and complexities, and kind of give you a overall understanding of that first. So some of the topics that we'll cover today include the importance of Social Security, especially as it relates to working with our clients on this decision. Social Security is a really important part of retirement for a lot of the clients that we'll work with because, in many cases, Social Security is a majority of retirement income. It could result in potentially, over $1 million, depending on what your client's circumstances are. And so we'll talk about the important facts, the problems that your clients may face with these decisions and the questions that they have. We'll talk about some Social Security strategies. We're also going to talk about the Social Security basics, including the important terms, the types of benefits, as well as how benefits are calculated. And then we're going to wrap it up with some filing factors for our clients, whether that's the marital status, if they have any dependent benefits, as well as employment status, if they plan to continue to work, and what that looks like as far as relating to Social Security goes as well. So first, let's talk about why Social Security is important to helping our clients with these decisions. Well, if you think about the baby boomer generation, right, over 11,000 people are going to be retiring every single day, and they all have questions on Social Security, right? It's in the news. There's a lot of clickbait out there. There's a lot of misinformation. And so the more we can help our clients with their Social Security claiming decisions and their questions, and also having that level of education and knowledge to be able to ask them the right questions back, that's going to ensure our clients are making the best and right claiming decisions, while also putting themselves in a position in retirement that they feel comfortable with, which is also related to the other services you're already providing, right? If you're doing assets under management or taxation or insurance, all of those things kind of correlate back to helping your clients with Social Security, because when you help them with that as the cornerstone of retirement, it kind of organically opens the door for insurance, annuities, assets under management, those other ancillary product sales. Now, for many clients, they think it's just a retirement program, but Social Security really covers a lot of other benefits, right? There's spousal benefits, ex-spousal benefits, survivor benefits. There could be ex-spousal survivor benefits, dependent benefits if there's minor or disabled children. You might have clients who are disabled or even have those disabled dependents. And then there's also those who are self-employed as well. Now, it's also important to know that Social Security is one of the only forms of a guaranteed progressive benefit, right? The days of those pensions, those private company pensions, are pretty much over. And so what are the other guaranteed retirement income? Social Security being one, and maybe annuities. But other than that, it's very hard to find a form of guaranteed retirement income. And a lot of clients, when we're working with them, they seem to be interested in those guaranteed retirement income forms, as well as those discretionary income to meet those discretionary expenses that they'll have as well. So, this is a great way to talk to not just your clients, but your prospects, and get them engaged to learn more about Social Security, which in turn, as an advisor, will help you open the door for those other ancillary product sales. Now, a big problem that our clients have, and even us as advisors, if we don't understand everything there is to know about Social Security to answer those clients' questions and help them with their claiming decisions, is that there's so many rules around Social Security. There's over 2,000 rules that govern the program. And the important thing is, what are the rules that impact each client specifically? Right? It's important to know that Social Security planning shouldn't be done in a vacuum. Every client that we have has a different, unique situation. Some are still working, some aren't. You might have a spouse where they are working and the other spouse isn't. Maybe they have a lot of retirement assets. Maybe they don't have any retirement assets or very little, right? So all of these different circumstances tie into you helping your clients with this decision. And I think as advisors, we want to be able to provide our clients with that suitability and that fiduciary service and help them with this, as well as the other aspects of their retirement. Now, the big problem is that a lot of clients don't know where to go to get this help. So we want to be that reliable resource as advisors, right? To be able to help them with these decisions. We can't send our clients elsewhere. We don't want to lose our clients. But also, if we send them to the Social Security Administration, by law, the Social Security Administration is not allowed to give advice. They're allowed to answer questions, but unfortunately, they answer questions wrong a lot of the times. And, it's up to our clients ultimately to get the education and get those questions answered, not necessarily from a rep at Social Security who's going to give them wrong or misleading information, but from their advisor, which is why we as advisors can become very helpful in those decisions. Now, realistically, with Social Security, as many of you probably know, is it needs to be taken with a holistic approach, not just looking at Social Security, but using Social Security as the door opener to have a better understanding and overall knowledge about that client that you're working with. What are their retirement goals? What's their other income? What are their expenses, right? They might have fixed expenses like mortgages, credit cards, loans, food, utilities. They might have some variable expenses like travel and shopping, but ultimately we want to know what expenses they'll expect in retirement and how can we offset some of those expenses with the retirement income that they'll have. And again, maybe we're using guaranteed retirement income like Social Security and annuities to cover the fixed expenses, and then some variable income like 401ks, IRAs, and things like that to cover those more variable expenses. But overall, when we're working with clients, we want to help them in every way possible that's going to put them in the best position in retirement. That's going to help us as agents and advisors because we're going to get their business, we're going to get referrals, we're going to get great reviews, and that's just going to increase our business substantially by doing all of this. Now, next, I want to talk about some of the Social Security basics. There's 4 important terms that I like to go over. And, with Social Security, there are so many terms out there, but these 4 terms really pertain to just about every single one of our clients. And so it's important to understand at least these 4 terms when you're speaking to your client base or your prospects. Obviously, full retirement age is a big one. Full retirement age we'll talk more about, but that is when your client or prospect will receive their full unreduced benefit. And that benefit at full retirement age is known as the primary insurance amount, or the PIA. That single number, which is on the statement estimate, and it's how all the benefits from 62 through 70 are based off of this specific primary insurance amount, or also you might hear PIA. Now, there are ways to increase this PIA from either continued years of future work that's replacing some of the client's smaller years, and also cost of living adjustment, right? That continues to compound, which is another important term as well. Because cost of living adjustment comes out every year in October and hits benefits in December, those cost of living adjustments will increase every client's retirement benefit from 62 and on, whether they're collecting benefits or not. They don't need to be collecting benefits. As long as they're 62 or older, every client gets that cost of living adjustment. So there's really no need to tell our clients to rush to collect if we hear that there's going to be, a 5% COLA. They'll still get that whether they're collecting benefits or not. Now, with the cost of living adjustment, they also get a guaranteed percentage increase by waiting to collect after full retirement age, which is known as delayed retirement credits. Now, that delayed retirement credits is 8% per year by waiting after full retirement age. Anyone born in 1960 or later now has a full retirement age of 67. So by waiting 1 year to 68 or 2 years to 69 or even 3 years up to age 70, they can get either 8, 16, or 24% onto that full retirement age primary insurance amount, with also the compounding cost of living adjustment as well. Now, besides full retirement age being the age at which a client can receive their full unreduced benefit, which is their primary insurance amount, they're also no longer subject to the earnings test. Now, the earnings test, as many of you might know, is a limit on how much a client can earn while collecting their Social Security benefit. But once they reach this full retirement age, they're no longer subject to those earnings limits. They can earn as much as they want. They can earn $1 million, and they won't have their benefits reduced by that earnings test. Now, also, if you notice here on the screen, and a lot of you might already know about full retirement age, but if you're unsure of it, you could look at this screen to see what the full retirement age is, depending on the year that someone was born. Anyone born in 1943 to 54 has a full retirement age of 66, and then it incrementally increases 2 months each year until 1960 or later now has a full retirement age of 67. So as we continue to help the baby boomer generation and years to go on, most of our clients will probably end up having a full retirement age of 67, right? But it's important to know from 62 through 67 what decisions those look like. And then at 67, does it make sense to maybe collect and continue to work because there's no more limits? Or do we still think the best strategy for them is to wait till 68, 69, or 70, getting some of those delayed retirement credits? Now, there's also 2 other rules that are surrounded by the full retirement age. The one rule is the 6-month retroactive payment. Once a client reaches full retirement age and after, they can actually go back up to 6 months with a one-time lump sum payment and then have a monthly payment going forward. Now, again, it can't go before full retirement age. So to get the full 6-month retro, they would have to be at least 66 and their full retirement age and 6 months, right? Let's just say their full retirement age is 67. They need to be 67 and a half with the 6 months to go back to 67. Now, just know that if someone decides to do a retro payment, that their monthly payment going forward is based on what they would have gotten 6 months ago, not the monthly payment going forward of what that current month is. Now, this is a rule that not many people take advantage of, but it might help for, taxation purposes, saving on taxation and things like that. If you do have any specific questions on retro payment, please put those in the Q&A. I'll answer those at the end as well. Now, one more thing a client can do is the voluntary suspension option. Now, it's important to let you know that the restricted application is no longer allowed. In 2015, President Obama came out with the Bipartisan Budget Act of 2015, which no longer allows couples to take a retirement benefit while delaying a spousal benefit or the other way around. That's no longer allowed. And there's also a suspension of benefits was no longer allowed either. Now, this is different than the old rule. You're still allowed to do a voluntary suspension option. Now, basically what this rule does is if you've already begun collecting benefits when you reach your full retirement age, you can actually voluntarily suspend that benefit at or after full retirement age and then reinstate it back on up to age 70. So anywhere from that full retirement age through age 70, if a client has already begun collecting, they can voluntarily stop and then reinstate their benefit anytime within that full retirement age to 70. And the reason someone would do that is because once you stop that benefit voluntarily, it starts to get those delayed retirement credits, that 8% a year again, by delaying. Now, it also is important to know that that 8% a year, even though it's said like that, it's actually a monthly increase. And that monthly increase is 0.67% per month, which is simply just 8% divided by 12. So every month a client or prospect waits to collect their benefit, they are getting an increase. They don't have to wait the full year to get that increase. It's a monthly increase that they'll get. Now, for the cost of living adjustments, I think it's important as advisors that we're not necessarily looking at just what's going on today, but we want to look more towards the future. And the reason I say that is that based on statistics that we've seen is that most of our clients are concerned about outliving their funds, right? Longevity risk. Now, with Social Security being a guaranteed form of retirement income with an increase of 8% per year by waiting and compounding cost of living adjustments, we want to try to help our clients understand and optimize when they take those benefits, which is going to offset some of those longevity concerns and that risk. On top of that is by you helping them with other important aspects of their retirement with Social Security, it's really going to help them with those with that longevity risk as well. Now, with cost of living adjustment, as you can see here on the screen, we obviously had, over the last 3 years, the highest cost of living adjustments that we've had in over a decade, right? It started at 5.9% in 2022, shot up all the way to 8.7% in 2023, and then it ended up coming down pretty substantially in 2024. But as you can see, the 3.2% is still a lot higher than what we had in 2021. And even before that, we had cost of living adjustments that were like, 0.1, 0.2 in some years. And so we're still in a better position now. Now, some of the types of benefits that we will be discussing today are the four main ones. And there's also disability benefits and SSI and other things like that. We won't dive too much into that today, but the benefits I do want to review include retirement benefits, which is a benefit based on a client's own work record if they have enough credits to qualify. Spousal benefits based on a spouse or ex-spouse's earnings record. Survivor benefits, which is based on the record of a deceased spouse or ex-spouse. And then there's also dependent benefits, and this could include biological children, adopted children, stepchildren, and even a dependent grandchild in some cases as well. Now, the first thing I want to discuss is how benefits were calculated. Now, the reason I bring this up is that a lot of advisors and agents and even prospects and consumers that we'll work with are confused as how their Social Security benefits are calculated. We hear things like the last, 5 years, the highest 10 years, the last 3 years. There's all very misconceptions out there about how benefits are calculated. And so to clear things up, if you don't already know, is that Social Security takes your top 35 years. And it's not just a simple 35 years of earnings that they're counting, but they're taking your highest 35 years of indexed earnings. Now, indexed earnings are basically taking all of the earnings that anyone has had, either your clients or even yourselves, from 59 and before. All of the earnings that someone has are indexed for inflation. And so there's an inflation factor, as you can see here in this column, that is multiplied by the person's actual earnings, and whatever that amount multiplied together is gives that person an indexed earning. So from 59 and before, the earnings are indexed. From age 60 and on, the earnings that someone has are taken at face value. So there's an indexing of 1.0, which simply says that if you earn 50,000, it counts as 50,000. Now, overall, you don't need to know too much about all of the specifics, but you do want to let clients know that their benefits are based on their top 35 years. And also, with that 35 years, if they don't have 35 years of work, they do count zeros into that as well. Now, with that being said, if we have clients who earn more later in their life, and typically that's usually what does happen, obviously, as years go on, inflation goes up, people are getting paid more. And so they're replacing their smallest years in their high 35 with their future earnings, right? So if we have clients who are planning to work another 2, 5, or even 10 years, they can significantly increase those benefits in their later years, in their 50s and 60s, which is going to replace those smaller years and in turn can significantly increase their Social Security benefits. Now, with those top 35 years, again, what that's creating is the primary insurance amount, or the PIA, which is simply the monthly amount someone would receive at their full retirement age. And it does have a little bit of a calculation that goes into it. We don't like to confuse clients about how it's calculated because they pretty much don't understand, but we do want to let them know things like that their benefits are based on the top 35 years. It creates a primary insurance amount, which is their full retirement age amount, and the amounts that they would get taken before full retirement age from 62 through full retirement age, and the delayed retirement credits they get after up to age 70 are all based on this amount. Now, also, I'm sure many of you have either seen a client's statement, Social Security statement, or maybe you've seen your own. But it's important to know as advisors that the Social Security statement is not always that accurate. If you're currently using a Social Security calculator or some kind of software today and you're simply just putting in the statement amount, you're doing your clients actually a disservice because that statement amount could be off upwards of, I've seen $1,000 off, right? It's not always that accurate. And it's because the Social Security statement is meant for a few assumptions and estimates. It's not supposed to be that accurate. And so if you're doing that currently, you want to take a step back and say, okay, if this is not really helping my client, I don't want to put myself in the position where I'm giving them wrong or misleading information as well, right? And on top of that is, the Social Security statement and the Social Security website is simply looking at each individual person. It doesn't take into consideration if they were married or if they, have an ex-spouse, dependents, and all of those other factors that really need to be factored in before a client can make their decisions. And that's why a lot of people actually leave potentially hundreds of thousands of dollars on the table, is because they're looking more of a tunnel view rather than an overall plan, which is really where all of you come in as advisors. It's not just about Social Security planning, but it's about Social Security planning with the planning around their whole holistic retirement situation, which is why, as advisors, using Social Security can really open the door for other ancillary product sales. Next, we're going to be talking about filing considerations. Now, the first thing I want to talk about here is retirement benefits and the reductions and those delayed retirement credits. So for a retirement benefit based on one's own work record, they simply just need 40 quarters to qualify. Many of you might already know that, but that's around 10 years worth of work to qualify for a benefit on their own work record. Once they have enough credits to qualify, then they take those high 35 years of earnings to do those calculations for the PIA. Now, for a retirement benefit based on your own work record, you need to be at least 62 years old. Technically, it's 62 years old and 1 month. You need to be 62 for at least a whole month before collecting, and you can collect up to age 70. Now, there's also some misconceptions out there that you can collect after age 70, right? And I think that kind of gets misunderstood from the new RMDs that are at age 73. I've actually spoken to advisors who told their clients to wait till after 70. And that's surprising to you, don't be, because there's a lot of advisors out there giving wrong information as well, which is why I'm glad you're all on this call, because hopefully you're learning some of the things that you can help your clients with. Now, if we have, let's just say in this chart, an example of a full retirement age of 67 and that primary insurance amount is 2,500, again, that would be the full 100% of the benefit. And as you can see here, you'll see the percentages for taking early, which is 2,500 down to up, 1,750 at 62. And then if we go the other way, those delayed retirement credits, that 8%, then we go from 2,500 at age 70 up to 3,100. Now, I don't think the huge difference here is looking at 2,500 to 3,100. Obviously, $600 a month, which is in today's dollars, that doesn't account for cost of living adjustment or future earnings that increase benefits. But it's really about clients who say, I'm just going to collect at 62, right? And that's 1750 versus 2500, or the 1750 versus 3100. That's where the significant impact is really shown. And, we've probably heard this a million times, but clients say, well, I don't know how long I'm going to live. I could be gone tomorrow. And if a client ever says that, this is where that longevity risk comes in, because people are too concerned about today and they don't think about the future. When they turn 80, 85, even 90 years old, do they really want to put themselves in a position where they don't have enough money to live on? No, I'd rather protect my longevity. And at the same time, is if they collect now and they think they're going to be gone tomorrow, they won't be around to even spend the money anyway. So, I mean, to me, that logic just doesn't make sense. Hopefully, we can have these conversations with our clients to help them make the best decision and outweigh that longevity risk that a lot of people are concerned about. Now, for spousal benefits, the spouse or ex-spouse doesn't necessarily need to have the 40 quarters. As long as their spouse, who they're collecting on, does have the 40 quarters, spousal benefits, you don't need to have your own 40 quarters. Now, if you do have enough credits to qualify for your own record, but you also are eligible for a spousal benefit on top of that because it's more than what you would get on your own, then that's called dual entitlement, meaning that you might have clients who are entitled to their own retirement benefit and then a benefit from a spouse, or ex-spouse on top of that as well. Now, for spousal benefits, the requirement is the same. You need to be at least 62 years old. If you're currently married, you need to be married for at least 1 year. Now, for an ex-spousal benefit to be collected, the client needs to be married for at least 10 years. Now, that rule is very strict. If you have clients who are married for 9 years and 10 months, they still will decline it. It has to be the full 10 years that they were married in order to collect on an ex-spousal benefit. Now, for spousal benefits, if they're married, both spouses need to be collecting. So you can't collect off of a spouse until that spouse has already begun collecting on their own benefit. However, again, if you're dually entitled, you could start to collect on your own benefit, and then the spousal benefit portion might kick in once that other spouse does begin collecting. And again, it's not a switch. You can't switch from one benefit to the other anymore, but it would be an additional add-on. So you would still get your own retirement benefit. If the spousal portion is higher and you can get that extra add-on, that will automatically kick in once that other spouse begins collecting. Now, it's also important to know that for divorced spouses, that your client and their ex-spouse both need to be at least 62 years old to collect, and the client that you're working with who wants to collect on their ex-spouse needs to be at least 62. Now, there's also a rule called independently entitled. Now, like I said, with spousal benefits, the other spouse that you're collecting on needs to be collecting their own benefit. But for divorce situations, that is the same unless you've been divorced for 2 or more years. If you have a client who's been divorced for 2 or more years, it's called independently entitled, and they don't need to wait to collect an ex-spousal benefit until their ex-spouse does collect. They can collect at any time. Now, for spousal benefits, it's also important to know that spousal benefits don't increase after full retirement age. As you can see here, it's 50% of that primary insurance amount at full retirement age and all times after, because it doesn't continue to increase. However, if that spousal benefit is taken before full retirement age, that benefit can also be reduced. And again, a big misconception is that spousal benefits are based on the other spouse's benefit, but that's incorrect. It's based on the other spouse's primary insurance amount. Now, again, for dual entitlement, just as an example, let's just say that Betty, in this case, has her own retirement benefit of $900 per month, but the full spousal benefit would be $1,050 per month. Now, again, that's because the spouse has a PIA of $2,100, in which the 1,050 is half of that, right? The full 50%. Now, what happens is Social Security always wants each individual to collect as much on their own record first before collecting on another. So, in other words, Betty is going to collect her own $900 retirement benefit, and the extra $150 that adds up to the full spousal benefit will come from the spousal portion, right? And so Betty might decide to take her own benefit at 62 and get a $630 benefit on her own record. But if the spousal portion doesn't kick in until she's 67, she'll actually get the full $150 benefit with that $630. Now, this is where it can kind of get a little confusing, but what we want you to know is that these are two separate benefits, and there's collecting Betty's own retirement benefit, and then when that spousal portion kicks in and what that ends up being as well. Now, there's also survivor benefits, and this could be more simple if you have two spouses who've been married for, many years and they're in their late 80s. Usually what happens is the survivor benefit is based on the higher of the two earners. So if you have one spouse who's collecting $3,000 and the other spouse is collecting $2,000 and the $3,000 spouse is the survivor, because they have the higher benefit, they'll just continue to get that benefit. However, if you have a spouse who is collecting a $3,000 benefit, but the $2,000 benefit holder is the survivor, then they continue to get their $2,000 benefit, but the survivor benefit would be that additional $1,000 to add up to that higher benefit amount of $3,000, right? And again, it's same concept. Social Security wants you to collect on your own first before another. So even though it's a $3,000 survivor benefit, she'll still get $2,000 from her own record, and the $1,000 to add up to the $3,000 will come from that survivor benefit. Now, again, that's assuming that you have two of couple, they're in their late 80s, that one passes, it's almost an automatic switch. With younger widows, maybe in their 50s or 60s, they can collect a survivor benefit, which could be reduced if they take it before their full retirement age. If you collect a survivor benefit at or after full retirement age, essentially what happens is that switch. But if you collect a survivor benefit before full retirement age, there are age-based reductions. But the difference between regular benefits and survivor benefits is that you can collect it as early as age 60. Now, for survivor benefits, you need to be married for at least 9 months. Remember, for spousal benefits, it's 12 months, 1 year. But for survivor benefits, you have to be married for at least 9 months. If divorced, same concept, you have to be married for at least 10 years. Now, as I said before, that strategy that was phased out by the BBA 2015 by President Obama, where you can no longer take a retirement benefit and delay a spousal or the other way around, you could still do that with survivor benefits. So survivor benefits, again, start at age 60 and don't increase after full retirement age. Let's just say that is 67. And retirement benefits start at 62 and go all the way up to age 70. So with the survivor benefit, if you have a younger surviving spouse, they can actually take the survivor benefit first while delaying their own benefit up to age 70. Or if it works out to have more income the other way, they can take their own retirement benefit first as early as 62, but then they wouldn't delay the survivor benefit past their full retirement age because it doesn't increase. Now, all of those different options between there of when should I take survivor, when should I switch to retirement, or the other way around, that's a huge decision, and why a lot of our clients leave potentially hundreds of thousands of dollars on the table. One, from not knowing that rule that you can switch, but two, not knowing when to switch and all of the rules that surround that, which is important to help clients understand as well. And all of the imagery that I've shown you through this presentation is all based on the RSSA roadmap software. That's our own proprietary software technology that takes into consideration, every single situation from single, married, divorced, widowed, dependent benefits. And we give you these heat maps that show every single option from 62 through 70. And I just wanted to point that out because, again, what we like to do, when we train agents or advisors to become registered Social Security analysts, RSSAs, is not to simply put in the estimate, right? Not to look at a single client and kind of just do, a little bit of Social Security planning. What we do is more in depth, right? We genuinely help our clients with everything they need to know about Social Security, and it opens the door for other opportunities with their finances and their other retirement situations as well. Now, there's also dependent benefits. And, if you've ever worked with clients who have dependents, this actually happens more than you would think, especially if there's spouses that are married and they have a significant age difference. But any child who's a minor child under the age of 18 or 19, if they're still in high school, can collect a benefit while the parent is collecting while they're alive, right? There's a big misconception that they can only collect when they pass. As long as you have a parent who's collecting a benefit, and the child is under 18 or 19 if they're still in high school, they also can get up to 50% of that parent's PIA. Now, it doesn't take away from the parent, but it's an additional add-on. There's also children who can collect that have disabilities. If they have a disability that was onset before they turned 22, they can collect a disability benefit from that parent as well. Now, there's also a young spouse that is any age as long as they're caring for a child under the age of 16 or a disabled child, and that spouse can be any age and collect a benefit as well, which is called the in-care spousal benefit. So there's a few different dependent benefits, and usually one or more people can be collecting off of that parent at the same time, which kind of segments into the family maximum. Now, the family maximum is a Social Security rule that impacts those who have multiple dependents, and it limits how much Social Security will pay out based on one earner's record. So if there's 5 dependents, they're not going to pay every single dependent that 50% of the PIA, and so the family maximum limits how much will be paid out per earner. Now, you might also come across a situation where you have a client that has what's called a non-covered pension. Now, a non-covered pension is not like a traditional 401k or anything like that. It's more of a pension that is from work in which Social Security taxes were not withheld. This is a lot of government-related jobs like teachers, firefighters, police officers, not in every state, but in some states, the teachers or the government workers will pay into a pension plan, but they don't also pay into Social Security. Now, this impacts around 2 million people a year for one of the rules and 800,000 people for another rule. Now, the 2 rules that impact those who have non-covered pensions are the WEP, which is the windfall elimination provision, and the GPO, which is the government pension offset. Really, the difference is that the WEP impacts one's own retirement benefit based on their own work record, and the GPO impacts any spousal and survivor benefits. But it's important to know that if you ever work with clients who have a non-covered pension, one, the Social Security statement doesn't tell them the impact of it, so they don't even know when they go to do it. 2, clients either try to get away with it or they don't understand they should tell Social Security about it, so they receive a large overpayment because they were overpaid based on that. And this can significantly lower their Social Security benefits that they get, depending on which one of these rules and what that impact of is that rule. Now, the other thing is, and we talked about this a little bit earlier, is the Social Security earnings test. And again, this limits how much clients can earn while they're collecting their Social Security benefits before full retirement age. Again, from full retirement age and after, clients can earn as much as they want. They can earn millions of dollars and they won't have their benefits reduced. But before full retirement age, if they earn over the limits, they could have their benefits reduced. Now, it's also important to know what counts as income and what doesn't count as income towards these limits. Really, all of the earnings test limits are just based on W-2 wages from employment or net income from self-employment. Pension payments and annuities and dividends and rental income, things like that, that are retirement related, do not count as income towards these tests. It's just about earned income from wages. Now, there's 2 different exempt amounts. The first one is $22,320, in which $1 for every $2 over that limit would be reduced from that person's benefit. And then $1 for every $3 earned above $59,520, which is the year that they'll reach full retirement age. So what happens is all years from 62 through the December before reaching full retirement age, clients are subject to the lower limit. From January of the year that they'll reach full retirement age through that FRA month, they'll have the higher limit. And then from full retirement age and on, there is no limit. So it's just a couple different exempt amounts. But I think the important thing to know here is that clients generally don't know that there even are earnings limits on how much they can earn while they collect before full retirement age. And that's why a lot of times our clients might receive an overpayment, or not our clients, hopefully, because we're educating them on this. But a lot of people who go to collect Social Security don't know about the earnings limits. And there was actually a 60-minute interview on Social Security overpayments, and it talked about how many Americans are put into really tough positions because they received wrong or misleading information about things like this from a rep at Social Security, and now they owe back 50,000, 100,000. I've even seen a $250,000 overpayment, and this is the last thing that we want for our clients. And there's really no, there's no getting out of it, right? And this could easily be avoided, but we have to be able to educate our clients on these things before they make these life-changing decisions. Now, if anyone is interested in learning more about the RSSA Social Security Program, one, you could send me an email if you're looking for more program information on how we train and educate, advisors and agents. The program includes a 5-module e-learning self-study course. We have a final exam to earn the RSA designation. The course and designation is approved for continuing education credits by Broadridge, FI360, NASBA, the CFP board, and the IRS. We're also in 47 out of 50 states for insurance CE as well. So aside from getting CE, you're also getting technology, support, training, and everything else. I would, at least just look into this, see if this is something that you might be interested in. We also have a significant discount for you all on the call through the end of March, which is a package fee of normally $23.29 for just $19.50. You can use promo code FPAGA to save. It's actually a $479 savings, or for $29, I think. It just brings it down to $1,900 from $23.29. You can get started at narssa.org/package if you're interested to get going on that, if you want to just get into it. But again, if you want to learn more, if you're interested in learning more about the program, you could send me an email and I'm happy to answer any questions that you have as well. So yeah, let's get into some questions. If you have any questions, please put those in the Q&A at this time. I'm happy to answer any questions that you have. In the chat, I just want to also, so that everyone has it, I'll put my email in the chat as well. So again, if you have any further questions about today's presentation or interested in learning more about the program, send me an email. I'll also give you the landing page website to go to, which is narssa.org/package. And the promo code for the discount is FPAGA. So I put all that in the chat for you just so that everyone has it. Okay, so the first question is, what about a spouse whose ex-spouse is deceased? When can the ex-spouse begin collecting? What about the age of the deceased spouse? They were married more than 10 years. All right, so there's a lot to dive into this one. So what about a spouse whose ex-spouse is deceased? So if you have an ex-spouse that is deceased, if you have a client who has an ex-spouse that's deceased, they can collect an ex-spouse survivor benefit. Now, the spouse that you're talking about, that you're working with, potentially your client, they can't be remarried. If they get remarried, they give up the ex-spousal benefit. But if they get remarried after age 60, they could still collect the survivor benefit. If you get remarried before 60, you give up both. If you get remarried after age 60, you're still entitled to an survivor benefit, but you give up the spousal benefit. The next question is, what if a 62-year-old widow is working and takes her benefit? Isn't it reduced? How does taking her benefit at 62 affect the calculation? So if you have if a client has their own retirement benefit and is also entitled to a survivor benefit, before full retirement age, both of those benefits are reduced, and both of those benefits are subject to the earnings test. So if someone's working at 62 and they're making well over the earnings test, it doesn't make sense for them to collect either benefit at this time because it's just going to be completely reduced depending on their income. The next question is, what about grandmother who's taking care of a grandchild whose parents earned nominal income? So a grandparent can have, can be collecting, and the dependent grandchild can be collecting from their record only if that grandparent is legally adopts them in some sort of way. So if the parents still have custody and the kid lives with the grandparents, that's not enough. The grandparent actually has to have custody and legal documents saying that they're under their care. The next question is how to determine if a client has a non-covered pension. So that's a great question. So if your client, if they have a pension and you're not sure if it's covered or non-covered, they can ask the pension, department, or they could just look at their check and see if Social Security taxes are being withheld. If all of that fails, usually an easy way to tell is from the client's earnings record. Now, the earnings record on the My Social Security account, just so everyone knows too, and this is important, is that the new statements from 2 years ago and on now have the first few decades of earnings from that client that are combined, right? So from like 1980 to 90, 1990 to 2000, they'll have just a combined amount. If you want the client or you yourself to look at the full earnings record, they can actually click on the tab in their account that says review their full record, and that will show each year individually. Now, when you look on that full record, if you see in the Social Security column a bunch of zeros or numbers that don't add up to what they actually earned in that year, usually that's an indication of a non-covered pension because they didn't pay into Social Security during those years. So there would be zeros there, but they know they've earned money during that time. That's usually a telltale sign that they have a non-covered pension. The next question is, if a young widow, 45, has a child in care benefit, will it continue if she remarries? Okay, so that's a good question. So we have a young widow, 45. The one of the spouses passes away, but they're collecting a survivor benefit because they're caring for a child under the age of 16, right? So the child is eligible up until 18 or 19, but that young widow is also eligible for caring for a child under the age of 16. And so they're getting a spousal in care survivor benefit, and the child is getting a survivor benefit, which is usually around 75% each of that primary insurance amount of the deceased. Now, the question is, if she gets remarried, does she give that up? And the answer is yes, she would give that benefit up. The child may still be eligible for the benefit, but now the in-care benefit she's getting will probably be given up once she gets remarried. All right. So again, if you have any more questions, please feel free to put that in the Q&A. We have another few more minutes here. And again, if you're looking for more information on the program, there's information here on the screen, but also send me an email if you ever have any questions about the program or Social Security. You may also be looking for, more information on, how your clients can get help if you're not interested in joining the program yourself. If you're not interested in becoming an RSSA yourself, but you still want to offer this kind of service to your clients, you can reach out to me as well. We can work with you on that also. The next question is, does it in most cases for a spouse to wait until full benefit age to begin collecting and then wait for a spouse to begin collecting at 70? So, a big thing with Social Security is that, it's very circumstantial. Every client has a different set of circumstances. It's not always about, clients will ask, right? Should I take at 62? Should I take at 70, full retirement age? You can't give them a definitive answer without understanding them more fully, which is really where the opportunity lies as advisors, because we're telling them we can provide them with a full personalized Social Security analysis, go through that with them, open the door for an annuity or assets under management, and really help them not just with Social Security, but their other financial aspects, which is a really great way to lead in with Social Security and open the door for other circumstance, other sales and other opportunities but I never tell a client without knowing more information what to do. And even when I do know more about that client, it's really about educating them and helping them make the best decision without actually telling them what to do. Some people like to know exactly what to do based on a recommendation, but a lot of times you want to point them, with the education and information to make that best decision. So you mentioned that the Social Security statement may be off by upwards of $1,000. What is the best way to get an accurate answer for a financial plan? So, a big reason that the statement is not always accurate is because a lot of times they'll make assumptions that may or may not happen, right? The only way to really accurately, understand what their benefits are from 62 through 70 is through using the full earnings record to do the actual calculation. Now, again, our software, the RSSA roadmap, you're able to put in the client's information and the full record, and it's going to produce the numbers that are the most accurate. And again, it's because we're not putting in a estimate amount, we're putting in the full client's earnings record every year that they've worked from 62 from the start of their career through today or even future earnings, and it's going to produce a report for them that gives the most accurate information. There may be other platforms out there that do that as well. What really differentiates the RSSA roadmap is simplicity, time management, and again, giving them very simple, easy to understand report that shows them their options, their numbers, their calculations, the rules that impact them, and providing them with that so that you can walk them through that and open the door for organic cross-selling opportunities. Next question is, what is the max monthly Social Security payment in 2024? So in 2024, I believe at 70, the highest payment is around, I don't know off the top of my head, honestly. I think it's a little over 4,400 per month, maybe. I don't know that off the top of my head, to be honest. Okay, next question is, how do clients find their income from their entire work history for the report? So there is two ways that a client can get their full work history. So on the My Social Security account, which is on SSA.gov, they could either create one if they don't have one already, or if they have one, they can go into it. A lot of clients probably already have one. And on that account, they could either download their statement as an XML file, and then we can upload that right into the RSA roadmap. Even though the paper statement shows the combined few decades, the XML file doesn't. It shows each year individually, so that can get uploaded right into the RSA roadmap. Or the client can also click on the tab on their account that says review their full earnings record, not the statement, review the full earnings record, and that's going to show each year individually as well. Let's see, can a client's PIA continue to increase until age 70 if they are still working and not collecting? So a client's PIA can increase, past 70, as long as the client is still working, whether they've begun collecting benefits or not, they could still increase their benefits by continuing to work and replacing some of their smaller years in their top 35. Let's just say that they're, let's just say they work 20 years and they have 15 years of zeros. If they're 65 and want to work till, 80 and get, those 15 years of zeros covered, they can do that. Even if they started collecting, what'll happen is, yes, they started collecting, but each year that they work and continue to work and replace a smaller year, Social Security will recalculate their benefit every January to replace the smallest year and add that new year of earnings in. So yeah, you can always increase the PIA by continued years of future earnings that are replacing the smallest years. And again, the cost of living adjustment increases that PIA as well. Now, again, with the PIA increasing, it's not just increasing the benefits that that person is getting, but if there's a spousal benefit, which is 50% of the PIA, because that increase, that spousal benefit, dependent benefits, and everything based on that record will also increase simultaneously. All right, so Kathy, that is going to be it. Why don't you come on and kind of wrap things up? And again, thank you so much for having me on today. I really appreciate it.
Thank you, Thomas. That was a great presentation. So informative. We really appreciate it. And thanks to everyone who connected with us today. Look for an event survey and replay to follow, and have a great afternoon, everyone.
Thanks, guys. Have a great day.
Thank you.